Donald Trump is doubling down on an economic vision that breaks sharply from conventional policy. Central to his plan is a sweeping protectionist strategy of steep tariffs paired with big tax cuts. The approach is billed as putting America first, but economists warn it could exact a heavy toll. Trump has floated imposing a universal 10% tariff on virtually all imports. Such an across-the-board import tax is unprecedented in modern history, raising the cost of nearly every foreign product overnight. Supporters claim this will spur domestic manufacturing and make foreign companies pay. In reality, it is a broad tax that American consumers and businesses would ultimately bear. Analysts predict a shock to the economy. Prices would leap on countless goods, fueling inflation, while trade volumes and growth decline. One estimate suggests this tariff plan alone could shave over a percentage point off U.S. GDP. Economists largely agree that tariffs are a poor economic cure. Trump's earlier trade war offers a warning. Those duties were mostly passed on to Americans via higher prices and did little to revive manufacturing. A blanket tariff on everything would only amplify these downsides. A universal tariff means higher costs throughout supply chains but scant benefit to show for it. Trump vows to get even tougher on China, ending its special trade status and imposing tariffs that could reach 60% or more on Chinese goods. Some advisors even talk of phasing in these tariffs over a few years, effectively aiming to phase out Chinese imports. The intent is to make importing from China so expensive that companies shift their supply chains elsewhere. In effect, this plan aims to sever much of the U.S.-China trade relationship in the name of economic self-reliance. The fallout would be enormous. China is a top supplier of goods to the United States, so a rapid decoupling would jolt many industries. American firms dependent on Chinese factories would be left scrambling for alternatives, but shifting production cannot happen overnight or without major cost. Many businesses, especially smaller ones, could not absorb a 60% surge in input costs. They would face a stark choice: drastically raise prices and risk losing customers, or shut down. Such pressure could prove fatal for many companies reliant on Chinese imports. China would almost certainly retaliate. It has hit U.S. exports like farm goods with tariffs in past disputes. Beijing could also restrict shipments of critical materials, such as rare earths, that U.S. industries need, creating new supply headaches. A trade confrontation on this scale could easily spiral, with damage spreading far beyond the initial targets. Though aimed at foreign producers, tariffs ultimately hit American wallets. Import taxes get passed along as higher prices for consumers. When businesses pay more for imported items, that cost gets added to final prices. From grocery staples to electronics, U.S. households will end up paying more. Analysts estimate the average household could pay several $1,000s more per year if these tariff plans take effect. Lower-income families would be hit hardest, since they spend a larger share of their income on necessities and have the least cushion. This shock would also complicate efforts to tame inflation, likely forcing the Federal Reserve to raise interest rates higher. Costlier loans and mortgages could then choke off growth. In effect, consumers would be squeezed twice, first by rising prices and then by rising borrowing costs amid a weaker economy. On the fiscal front, Trump promises major tax relief, chiefly by making his 2017 tax cuts permanent and adding new cuts. According to independent estimates, this plan would cost trillions of dollars over the next decade. Yet Trump rules out significant spending cuts to offset the lost revenue. Instead, he points to tariff income and optimistic growth projections to fill the gap. But any extra money from tariffs would arrive while the economy is slowed by those very tariffs, making it a shaky solution. The result would be surging deficits and debt. With less tax income and unchanged spending, annual deficits could hit new records, driving the national debt beyond its already high level. The government would need to borrow much more money at a time of rising interest rates. Paying interest on that growing debt would become costlier, creating a vicious cycle, higher interest payments fueling even larger deficits. Over time, this trajectory threatens the country's financial stability and leaves future generations with a massive debt burden. Taken together, these policies set the stage for potential stagflation or even a fiscal crisis. A trade-driven price surge combined with ballooning government debt is an unstable mix. If investors lose confidence in Washington's direction, borrowing costs could spike and financial turmoil could follow. Internationally, an all-out tariff regime would fracture global commerce. Other nations would retaliate or regroup into new trade blocs, and supply chains would be disrupted. The era of relatively free trade could give way to a new normal of trade barriers, higher costs, and heightened tensions. Trump pitches his agenda as a bold plan to restore American prosperity, but the risks loom large. The United States would be gambling with its economic stability, potentially trading short-term gains for long-term pain. In the end, this high-stakes experiment could leave the economy weaker, Americans poorer, and the country more isolated.